Hello, my YouTube friends, and happy Thursday. Well, I got dragged a little into it. Everybody keeps talking about the Fed cut. So I was also asked to say something about it and wanted to chat a bit of it and explain my thoughts and what I see going on. Um, Now, keep an eye out for those gloom and doomers because you're going to start hearing about the yield curve uninverting and how every time that happens, it predicts a recession. Now, I'm going to talk about why I think they're wrong because I just don't see it coming this time. And I hate that. Well, this time it's different. But to be fair, it really is because the reasons that the Fed usually cuts and raises are significantly different right now. And they're not cutting into a recessionary economy. They're actually cutting ahead of it just because they see some concerns with unemployment. And that's not typically the case. And the reason you're seeing the yield on invert is because they're cutting. Now, the long end of the curve generally is the prediction of what we have coming in the future. And the reason it inverted is because they raised rates so quickly. And I'll explain what this all means as we go along. But they raised rates so quickly that it forced the short end of the yield to go higher than the long end. I don't think the long end really ever took off because it just didn't see inflation sticking around a long time. And now that the Fed is reversing their course and beginning to cut their rates, you're going to see the short end come down, but you may not see the long end come down either, which is why it is uninverted at this point. And you'll see it hold steady if things go the way that they're hoping. Now, what that means for you guys is you're not going to see mortgage rates come down all that much. Now, they might in another 6 months or a year, but they've priced in these cuts already. In fact, I thought the markets had gotten ahead of themselves, and I really expected the Fed to only cut a quarter. And I thought the market would actually, sell off more than it has. It sold off even at 50 basis points, and you've seen mortgage rates get a little bit worse from the time that they actually cut the rates. And that's pretty typical. The banks put their positions on in advance because they're well aware these cuts are coming. When the Fed actually cuts rates, well, they're sometimes unwinding those positions because they got in ahead of the curve. It's not like the day the Fed cuts rates, you see all these things change. Maybe your credit card changes. If you have a home equity line of credit, that'll change when the Fed moves. But most things are fluid and are changing every day in preparation of what they see coming. The stock market, I think you'll see it continue to rally because what the Fed is really saying is they're going to readjust rates to be where they should be, which means the short end lower. It alleviates the borrowing costs for businesses if they need to do hiring or expand or anything like that, which allows them to start growing again. And the earnings were already good. That's why you're seeing the stock market take off today. It means there's less of a chance of the recession that everybody's talking about. Again, sorry to burst your bubble, gloom and doomers. And if they're already doing well and they priced in for a recession, they have a lot of room to run. And it really could be the big main tech companies that have run in the advance already. And you're also going to see the ones that pay dividends start to probably go up. Now, I don't know that I'd be running out and buying stuff this second. The stock market had a good day today, and I try to look for pullbacks. Also, keep in mind, as I always say, this is not financial advice. You guys need to do your own research. I'm just sharing what works for me and use this for entertainment purposes only. Maybe even reach out to a financial advisor and get advice from them if you want some help. But do your own research in making any financial decision, and don't be listening to guys on YouTube. You're seeing Meta pursed out to new highs. You're seeing Amazon totally reverse. It was up last I looked close to $190 a share. And to me, Google still looks like a discounted stock. I think with the overhang of what's going on with the DOJ and everything else, that they're still a bit discounted. And I think there's still a good opportunity there. Now, I'll explain the Fed fund rates and exactly what the Fed is raising and cutting when they make those changes, and why I don't really see it impacting mortgages too much. The Fed is in control of the Fed fund rates. That is the overnight rate that banks borrow from the Fed. So, what they cut 50 basis points was what the rate that the banks borrow from the Fed every night to keep liquidity. So if you're JP Morgan or Chase or whomever it is, and you have all this money that you're lending out, a lot of times you need to borrow. And where do you go? You go to the overnight window where the Fed has an open book with all of them and they can borrow as much as they need overnight. And they pay the rate that the Fed is charging. Now that impacts all other products because that's how they price what they're lending to other people. And when the Fed raises those rates, of course, typically they'll have to raise the rates of other things that span out, whether it's 3 months for CDs or 6 months, a year for some things, 2 years, 5 years, 10 years, and 30-year mortgages. Now, 30-year mortgages are generally based off of, loosely off of a 10-year treasury, but more specifically a mortgage backed security, but they move in conjunction with the 10-year. So when the Fed is moving the overnight lending, the other things may or may not move accordingly. So the Fed went from 5.3 something down 4.8 something by cutting the overnight lending by 50 basis points. The long end of the curve didn't move very much, and I think that's because they've already priced that stuff in. You'll see the 2-year and the shorter term ones probably move accordingly. And as they're dropping rates and the long end isn't moving, that's uninverting the curve. The reason that's going on is because the long end of the curve never saw inflation getting out of control. They didn't need to get to 6, 7, 8% to be able to encourage people to lend money. And if that doesn't make sense when I say lend money, when you buy a CD or you buy a treasury, you're lending that money to somebody else. You're putting your X amount of dollars into something to get the return that they're giving. Well, you're lending that out, they're borrowing it, they're giving you a percentage return to receive that money. Same as the overnight lending window from the Fed. Well, they're cutting it quickly. And like I said, quicker than I expect. They've actually priced in about another 200, so 2% basis points over the next 8 months or so, which is really quick. Now, I think the reasoning, as Powell said, we're going to readjust, is if CPI is in the high twos, there's really no reason to keep the overnight lending window up around 5%. It's just restrictive. And the only reason to do that is you have fear of inflation and you're trying to force the market down. The fact that they're getting more comfortable that we're not seeing inflation, there's no reason to keep it there. And I guess they're going to move it to more in line of where it should be quicker than I'd expect. If I were in charge, and thank God to you guys that I'm not, I really would do it slower because I haven't seen anything break in the economy, even though people are struggling. And it gives me room that if things did break, that I then could move quicker, which was my theory that they would move slower than fast. But I think what they're seeing is at this point, they're just being more restrictive for no reason, and unemployment's beginning to get uncomfortable. So why don't we put it in line with where it should be? Now, when I say nothing's breaking, the noise that I hear in the background about credit card debt being the highest it's ever been, the deficit, the politicians spend too much, and so forth, this is stuff I've been hearing since I was 10 or 12 years old. Nothing's really changed. There's been lots of other noise and everything else, but the reality is I've been listening to the government spending too much as far back as I can remember. I've been hearing about people being overextended as long as I can remember, and I've been hearing about people not being able to afford their bills as well. Unfortunately, that's how the world operates, and I don't see that changing no matter what the Fed does. I think that continues to the end of time. You're going to have people that are always overextended. Why I always say that I don't like inflation either. I don't like going out to the restaurants and getting sticker shock or wherever else it is. I'm constantly getting sticker shock. I can't stand it either, and I'm sure it puts a lot of pressure on people. But that's life, and that's not really changing. The reason it's different this time is usually the Fed is reacting to problems and cutting rates to try to get out of an economy that is already receding, like my hairline. Is that the right way to say it? But it's already going into the recession. It's not that the yield inverting or uninverting is predicting anything. It's that these things are already going on. And sometimes the reason it's uninverting is The long end is seeing inflation and they're seeing a recessionary period. So it'll come out of something that was okay. And when it uninverts, it's because now you're in the recession already. So it's going to reverse for different reasons. At this point, it's the Fed moving the markets to control things. And they have so many tools at their disposal at this point. It's really interesting that I really do think they're going to be able to control it and we're going to have a soft landing. So if the companies, going back to the stock market, are already having decent earnings, there's no reason to predict that all of a sudden, for no reason whatsoever, just because the Fed cut rates, their earnings will get worse. To be honest, their earnings should get better, and that's why we're seeing the stock market rip today. Maybe it's overdone, but honestly, I don't think so. I think that day a week ago Wednesday when the market was just dropping and it reversed and ended up higher on the day, that was like a key reversal for technicians. It was really good in terms of anybody who was bullish, and we just haven't looked back since, which is how those days should operate. Like once you make that move, you shouldn't really look back. At this point, like always, we'll have some ups and downs, but I think the general direction for the stock market is moving higher, at least through the election. And now I'm watching on TV Biden taking credit for it, which is a total joke. And I'm not political. I'm not saying it's this one's or that one's, but it's funny to me how a president or whoever tries to take credit for the economy when they really have very little to do with it. And it is much more just you and I. And then in the background, the Fed trying to help us out. Powell did say one interesting thing, since I like real estate and talk about that as well, that he is in control. He is not in control of the mortgage rates. Now, what I took that to mean more than what anybody else did is they're in no hurry to buy mortgage backed securities and support the market because the market's doing just fine the way it is. It's kind of where I'm going to, that I haven't seen rates come down all that much now that they've cut. They came down the past few weeks, but now that they literally cut, they actually reversed a tiny bit. It's not something that most people would even recognize. It's just actually your cost or credit that you'd get for whatever rate that you're looking at. It's not like you saw the rates really move all that much, but just in terms of basis points and the cost to get to those rates. And what I think he's indicating is unless that market really crashes, we have no need to support it and buy more mortgage backed securities, which means the spread between a 10-year and where interest rates for a mortgage are probably going to stay a little elevated for some time, because partially why they got restricted down to 2% is you knew that the Fed was there to buy as many as people wanted, so there was no reason to have that extra room for risk. If they're not buying mortgage backed, well, no reason for them to come down. Short end will come down since they're cutting rates. You'll see the yield curve uninvert and back to a normal type of economy. And hopefully the news stays super scared and super negative for a long time. We continue to climb that wall of worry, and all those gloom and doomers keep talking about how the recession's next week, it's coming soon, keep waiting, housing's collapsing, the stock market's going to collapse, it's all overpriced, there's too much credit card debt, people can't afford their bills, the inflation is still terrible, your insurance has gone up, you can't afford car payments, you can't afford this, you can't even afford that. Yeah, I know. But meanwhile, at the same time, when I go out, if I go down to the Wynn Casino, it is jam packed with all these people who can't afford it. When I go to Target, the parking lot is jam packed. When I check by Walmart, same thing. People seem to be out shopping. As you get to different holidays, my God, whatever we just had a week or two ago, you couldn't even get into Walmart. It was backed up so far. Labor Day. I mean, my wife was talking about the line to try to check out had to be all the way from one end of the store almost to the other, that she kind of gave up and walked out. So I don't see these places struggling. And as the Fed continues to ease and normalize the curve, things are just going to do just fine. I want you to try to. I think a lot of people who watch these channels and like this stuff, we get a little too close to the news. So we think it matters more than it does. Take ourselves away a bit, Walk outside, go around, and think about the average person you know who wakes up in the morning and goes to their job and gets their paycheck and does whatever they do with their family or friends and life. Do you think that the Fed cutting rates 50 basis points is really going to impact them? Or do you think them raising it is really going to make much of a difference? Or do you think their day is just their day? And my guess is their day is just their day. Anyway, before I forget, do me a favor if you haven't already, hit that subscribe button, smash the like button, make some comments, and tell me what you guys think.